Season's greetings and welcome back to Brave Ideas, where we chat with the leaders in commercial real estate to answer all questions, space as a service, and help office real estate reposition to meet the evolving demand from the future of work. If you're an investor, fund manager, developer, landlord, operator, property manager, agent, or broker, hit that subscribe button. And if you prefer to watch the show or join our newsletter, head over to braveideas.media. I'm your host, Caleb Parker, and this is episode 10 and the finale for season 16, brought to you by Mute and FlexSpace AI. I'm joined by my co-host, Gary Helm from Mute, to sit down with Rupert Dean, CEO and co-founder of x+why, in the Mute showroom in Clerkenwell, London. Rupert takes us back to 2019 and the very first x+why building, where an early landlord backed their new brand, signed a management agreement, and took equity in the operating platform. You're going to hear how Rupert's corporate finance background made him risk-averse to lease arbitrage, why x+why committed to management agreements from day one, and how that approach now runs across a 16-location portfolio. We unpack how x+why structures its topco and site-level P&Ls, how Rupert talks to owners who still want covenant and skin in the game, and which landlord profiles are more open to management agreements and operational real estate rather than a simple fixed lease. Rupert explains how x+why can run front of house, food and beverage, wider building amenities, and flex workplaces on a single platform where landlords want a whole building solution. And he shares a case in Birmingham, England, where a members club and amenity strategy coincided with rapid lease up in the rest of a 280,000 square foot tower. You can also hear the story of a former department store in Clapham Junction that has been reimagined as a members club and flex workplace in partnership with WRE London, shout out to Sasha Lewin, and how x+why and WRE leaned into the building's heritage, rooftop, and hospitality offering. Rupert shares his view about the right mix between private offices, dedicated desks, co-working, members clubs, and event space, and we go into the realities of B2B versus B2C demand, what really drives customer acquisition outside the London city core, and how word of mouth and community are shaping the customer base in that Clapham Junction location. Then we zoom in on adaptability and data. Gary and Rupert talk about modular fit out and products like Mute's booths and how that supports faster layout changes at lower risk. We then dig into how x+why is using an e-commerce and early stage dynamic pricing strategy across meeting rooms and offices today. Rupert shares what he thinks about AI, data lakes, and revenue management, and what that could mean for the next wave of hospitality-led workplaces. Before we jump into the conversation, here's a quick message from our partners at Mute. If you're a landlord or flex operator trying to future-proof your building without wasting time or money, this is for you. Mute turns traditional fit-outs on their head. Their Mute modular acoustic rooms can be built, moved, or reused in days, not months. That means lower capex, less waste, and faster returns, all while creating quieter, more beautiful spaces your members actually want to work in. No demolition, no downtime, no sunk cost. Just smarter design that upgrades, reuses, and profits. From static white boxes to dynamic workplaces, head over to mute.design/brave to change the game for offices that never stand still. Now, put on your favorite Christmas jumper or Santa hat and grab some mince pies to settle in for our season 16 finale. And of course, enjoy the festive break ahead. Without further ado, here's my conversation with Rupert and Gary. Welcome to Brave Ideas, Rupert.
Great to be here. Thanks for having me, Caleb. Yeah, exciting.
It is exciting. Great to see you. I think the last time I saw you in person, we were both wearing tuxes at the Flexa Awards.
It was quite a while ago. That was a good year ago now. I mean, things have changed a bit since then. So I remember the first time we met was at one of the conferences when I was working in Africa, and I came back. I was doing some sort of flex office stuff over in Africa, and I came back, and then I remember you were there, and there were quite a few other people who are still hanging around the game. A lot of people who aren't. A lot of people have sort of left us now or gone on to other things, but you've remained the constant.
Well, I've been called many things, but that's the first. So thank you. Have to give a shout out to Gary here. Thanks for being my co-host again and hosting us in the Mute Clerkenwell showroom.
Caleb, and lovely to meet you. Really looking forward to today's chat.
Thanks for hosting us, Gary. It's beautiful, lovely. Really nice, yeah.
Rupert, I've been wanting to have this conversation a long time, been following your growth over the years. And I want to dive into a lot of things, but want to really start with the beginning. Today, it's challenging to start a flex brand and grow it. When you started, it was also challenging, but different challenges. And that's what I want to unpack. In 2019, when you guys first set up X and Y, what was the hardest part for you to launch this co-working brand? And how did you do it? How did you overcome that?
Well, I think it's a good question. I think when you mentioned at the beginning, it was tough back then. I mean, it was difficult because at the time back then, obviously you had the sort of WeWork phenomenon that was taking over, but also was coming down, was sort of crashing down, and the name for kind of flexed offices, serviced offices, whatever you want to call it, it wasn't great in the market per se. But we obviously knew that there was still a lot of demand that was out there for that. But the key for us was kind of the governance element of it, because I was an ex-corporate finance lawyer, I should add, that I was always quite risk averse. And I kind of saw a little bit of the inequity and the definite risk inequity in traditional leasing when you buy long, sell short, no problem with people taking traditional leases, by the way, but just from a buy long, sell short, serviced office, flexible office perspective, it's always been difficult. And I was really clear that I didn't want to do that. I saw that as being one of the fundamental, and we won't definitely go into the WeWork saga, but that was definitely one of the kind of things that I saw that they were really struggling with. And so for us, it was management agreements. It was always going to be management agreements, always going to be partnerships based on trust and good governance with landlords. And so the first thing was to convince a landlord to take a punt on us in a building. So it was finding a building, finding a landlord, and making sure that they were happy to go with us. And we kind of got lucky in that respect, because my business partner at the time, Phil, did a lot of sort of charity work, and within his charity sphere that he was working with was Lord Virgie, who was a really interesting Lib Dem peer who came over and spoke to us, and he was really interested in the model. He was really interested in us. He had just bought a building in East London, and he was always about, and still is, about sort of blue sky thinking and doing things outside the box. Saw the opportunity, invested in us as well as into that building, and that was the start of it. But that's just the start. And obviously the main thing for us was how to differentiate ourselves outside of location. And for us, it was about how we build a brand. So we've always been very, very brand specific. And so Lord Virgie said to us, it's now about you guys going out, proving that you can start up this brand and you can raise a bit of money to be able to cover your cost type thing. And he invested alongside, which obviously made it easier. But that's when we got thinking about brand.
So Rupert, I want to unpack that real quick, because I think that's significant for any operators listening now, or for any investors and landlords listening. Your first location was in a building that the owner of that building also invested in the operating platform.
Correct.
When did the light bulb go off for Lord Virgie to say, I want equity in the operating platform?
I don't know if it was a necessarily light bulb moment, Caleb. I think that we pitched the idea of X and Y going into that building to him, and he liked it. It was done on the premise that we would go out and spend some money to be able to make it work and build the brand and all of those sorts of good things. And as part of that, he said, I'm actually interested myself in investing in this. So he kind of, let's say, cornerstoned element of it. And that's when it began. And that's when we went out to go raise the rest of the money, which was relatively fast. And we built the brand. And then he said, this is good to go. Let's go.
And did he carry on investing in other locations? Have you opened more locations with him? Has he stayed in the equity of the operating platform?
Yes, he's still a shareholder in X and Y. So X and Y is distinct from the individual building P&Ls, essentially. X and Y is a top co that operates a whole bunch of P&Ls at each site level. So he's at the X and Y level, that sort of top co level. And he obviously was also involved in the P&L at that site. That was the one building where he's done flex, to be honest. So hasn't it on, but we've remained very close because he's really interested in us. He's a really kind of interesting guy in how he's gone about his business. And I think that he loves the idea of kind of giving the time to other operators or other ventures to be able to see what can be done and to think outside the box a little bit. And he's quite into sort of business innovation. So he's always an interesting guy to talk to, so very present.
So Lord Verghese sounds like an amazing angel investor for X and Y in the early days, and you've grown to now 16 locations. And if I understand correctly, all of your locations are on management agreements. You're not doing the lease arbitrage model.
Correct.
Okay.
Yeah.
And it makes sense. You have the top co, as you were saying, for the operating platform, managing all the SPVs. Does the landlord, like Lord Verghese, do they get involved in the site level SPV equity, or is the site level SPV just earning fees to the top co while making money for the prop co that's owned by the owner?
Correct. The latter. Yeah,
Okay.
exactly. Under a straightforward management agreement, we are simply agent on behalf of the landlord, essentially. So it's their vision. We look at the building heritage history, what the landlord's vision, as I said, what that brand is for the building. And then we try and create a product based around that with their input, obviously as much or as little as they want to get involved, basically. And then we try and operate that, and to paraphrase, we take a share of the upside that building creates, essentially.
Amazing. At a exit opportunity, whether it's being sold or refied.
Yeah, so it's a part of the process is the management agreement itself, and obviously when there's an assignment, it just goes across.
Okay, got it.
Yeah.
So just on the upside, you mentioned upside. Are you meaning upside on top of base rent in terms of the EBITDA, or are you meaning when the building exits and reaches above a certain IRR, you guys are getting a promote on that?
There's nothing really traditionally, not saying that it wouldn't happen, but there's nothing related to the propco value. It's all on the opco value. So it's typically linked to a net effective, essentially. So agreeing the ELV up front is always the fun thing, and then netting back to a net effective is then what your benchmark is for performance.
I'm asking this because I've seen and I've been part of a lot of different structures. And I think no building, no deal is the same. It all slightly different, even though if you try to have a template, right?
I think I've done it in about 28 different ways, or like at least looked at 28 different ways, but I reckon there are 250 ways to do it. Yeah, it's there's a little complication. You've got to be quite commercial, but it's also about understanding what the landlord's drivers are.
250 different ways until you meet the next landlord, then it's 251.
Right. It's probably exponential, so it's probably like 300 because you can get at least 50 in one.
Absolutely. Look, and then I guess I want to come back to the challenges in 2019 to the challenges of today. In 2019, that was right at the time I had the moment the idea to start this podcast.
Wow.
And
okay.
and at the time we started the podcast because it was back when I was operating Bold. We got acquired by Newflex. We were pitching landlords management agreements, metaphorically getting the door slammed in our face. Yeah. And we thought, well, there's a lot of reasons that landlords should consider management agreements. WeWork was in its heyday. It was pre-crash. They were signing market leases. I've said this many times on this podcast, and those market leases or above market leases.
Yeah.
But we saw that lease arbitrage was going to crash at some point because they were overpaying. When the free rent was done, boom. And we thought, okay, well, a landlord signing a deal with WeWork gets cut off on the upside. They're limited, they're capped on the upside. But downside, in a crash scenario, they're massively exposed because it's an SPV, WeWork's going to pop the lease.
I agree. Yeah.
Whereas in a management agreement, the landlord's not capped on the upside, but they have the same downside risk.
Correct. Same downside. I mean, basically just comes down to SPV and covenant, right? And I mean, I think a lot of people have worked out that they, at least from WeWork, that they stayed faithful to during the downtime. It's still impacting, the covenant still impacts the debt and their investment, capital. And therefore there's still an issue, right? Regardless of whether or not they continue to pay for you, there's still an issue that comes with, well, does that mean I have to, is it financially as viable as if I got someone else onto a lease? Probably not. And I think that's a bit of a problem generally for the sector. But you're right, it also applies potentially to other people outside the sector. If it is in an SPV, is the upside limited? What happens in the downside? And I think there is a certain period of jux, like at the flex agreement, in terms of what landlords are thinking and their appetite for things like management agreements as a result, and particularly when we came out of COVID. So obviously, covenants were just blown out the window, right? Everybody was fighting, and therefore the people that were still building buildings and still trying to generate income through business development had to think very differently about what they were doing, which obviously played very well to us because we were out there as a result of only having management agreements to that date. We were very active during that kind of second half, let's call it, of COVID. And we came out and there were lots of people willing to chat to us about management agreements. There still are, but it's not so much of a sort of home run these days. You have to work quite hard for it. But also we're probably a little bit pickier these days as well in terms of the buildings that we look at, because management agreements are great. But they are great. But ultimately, you should only be doing these things if you know they're going to, if you're absolutely sure it's going to work, because otherwise you're just doing it for totally the wrong reasons. There was probably a little bit of that, still a bit of that probably sort of remnants of that in the market. But for us now, I want anything to do with anything that wouldn't otherwise be totally successful based on experience of the last 5, 6 years.
Well, over these last 5 to 6 years, when you guys came out and we launched this podcast, and management agreements were being like pitched to landlords, and they've softened their stance on that. Instead of slamming the door, now they're calling you and asking, hey, let's talk about this management agreement. And more and agreements are being done. There's more and more operators who used to be on these arbitrage are now doing management agreements. So there's a lot more competition out there for us, you and I. How are you responding to the competition? Do you participate in beauty parades? And how do you win them?
So I think part of it is the distinction in terms of brand. So when we mentioned at the top of the podcast that we went and built a brand, I mean, the key thing for us was to distinguish who we were as an operator from other operators. And a lot of that was around mission, legacy, values. So we wanted to be, you probably are aware that we're a B Corp, and we wanted to be building communities of like-minded businesses that were mission-driven, that thought about people and planet as well as profit. And we wanted to build those kind of communities, inspire them every day, and then amplify those that did it really well. Essentially, that we built a kind of community or space, and to some extent a digital space for people, whether you wanted to raise money, meet interesting people, create partnerships, hire people, whatever you wanted to do within the kind of better business community. X+why was a great landing spot for you. And we've stayed very true, I think, on the whole to our values. I mean, it's definitely a challenge to maintain, particularly as you go from sort of East London to West London. But I think we've been quite clear about that. And I think those values, the ability as well to be able to report very clearly, I think the only way that management agreements work is if you've got a clear brand proposition, which is different to a building brand, which we can come to. Your governance is seriously good so that landlords trust you and they can understand the numbers so clearly. So that you're taking them on the journey, that they never worry about the fact that you're not, a very trustworthy partner in this venture. And I think that's crucial, not because of the good times, not because it's important when you're high-fiving and everything's good. It's actually really important on the downtime, because it's really important when things aren't going well that you've built that relationship with landlords where they can go, I've got it. We all go through downtimes. What are we doing about it? What's your plan? Do you need investment? Do you not need investment? How do we structure that within a P&L? And you're having a commercial discussion with an open landlord. That's when it's really, really important. And I think for us, the last advantage is that we've only ever done management agreements. And so it's very easy to relate to a landlord and go, well, this is obviously going out on a podcast, so I'll probably give away the secret. But the idea is that we don't have any single favorite building based on upside or downside. They're all treated exactly the same because we've only ever done management agreements. Somebody who's got a lot of leases, when they go into a management agreement, and let's say that there is a plague or a COVID-related incident, or just anything that has a material impact on commercial real estate, where do you think those people are going to spend all their time? They're going to spend it where they've got the greatest liability. I think landlords probably still realize that. And so for us as a pure management agreement vehicle, hopefully that's an advantage.
Well, it's certainly compelling. And I've used a similar line in the past when CBRE was operating HANA, and CBRE was trying to pitch HANA into a building we were competing against. And CBRE was also the managing agent on the building. That was similar topic we brought up in the pitch. There's still landlords, as much as management agreements are being embraced. There's still landlords who are looking for that covenant. They're looking for the operator to put skin in the game. They're looking for the operator to sign a lease so they can capitalize it on exit. So how do you you walk away from those deals? Do you convince the landlord? Otherwise, how can a landlord get comfortable with a management agreement, variable income, when they might want to exit in a few years and need to be able to capitalize the income?
I think a landlord has to know that they want to do a management agreement. I think the moment you're going into a conversation with a landlord who's not sure, you've got to be aware that that's going to be a very difficult conversion, essentially. So I think for us, it's quite often RFPs, or quite often we hear about landlords who are happy to look at it. But I also distinguish very heavily between areas of what we do, because we also do front of house, we do food and beverage, we do wider building amenity, not just kind of revenue generating space. So that might be, co-working or flex workspace. So for us, we would have to just speak to a landlord about doing, the amenity in the building in the front of house, for example. No ERV necessarily, but looking at really good service and improving the overall tenant journey and experience within that building. The difficulty is quite often with the revenue generating space, the NIA or flex workspace that you also generate, because that's where they're like, okay, a management agreement doesn't really work for me there. So quite often we can blend these things, just do some, just do all, but we quite like to do the whole stack, but we'll work with the landlord based on what their risk appetite and profile is, as long as they like us, as long as they like the idea of putting service at the center of what we do and the experience within an entire building, we're on. And we'll have any discussion with the landlord. If you're just starting about flex workspace and co-working or serviced office space, it's a very small pool, I think, of landlords who are absolutely, totally and utterly committed to a management agreement on those spaces, particularly in central London.
I'm imagining that we're having like three chapters in this book here, yeah. And we're coming to the end of the financial management agreement chapter. So you just said that it's a small pool that would entertain management agreements. I agree. It's a smaller pool, but growing pool. And as much as I've been banging on about management agreements the past 5-6 years, I'm actually softening my stance on lease arbitrage a little bit. I think lease arbitrage can work when you go into a B building in an A location where you're getting a lower rent, so you can have much more margin by bringing an experience in. I think that can work if you can get the structuring of the deal right, get the incentives right from the landlord, because now you're a tenant. But then when you bring in the experience level back into the building to complement the building outside of the footprint, because historically, legacy in our industry, the great customer service that's being delivered is kept within the footprint of the serviced office co-working company, and the entire building gets a sort of a static experience. But as we go to flight to quality, as customers want more experience in a building to attract talent, what we deliver becomes, well, if we can cast that net across the entire building, and I think you guys are doing it really well. So when you think about designing for buildings, designing for X and Y buildings, you're designing aesthetics, but you're designing for a workplace experience. How do you think about that?
So we'll start. So it depends on the entry point of a landlord, what they're looking for, right? Because if they're looking for us to build value, wider value, to your point just now about what landlords can do outside of just talking to you about your workspace area, what is the value proposition that they're looking for? Because ideally, you can create, both from a design and an operational perspective, massively better quality service across an entire building. And that's what we talk about when we talk about a single platform for the benefit of the entire building and all the tenants in it. That's what X and Y, that's the point. And if people want to do workspace with us on a management agreement, then great, but they don't have to. And it could just be events and food and beverage and reception areas and front of house and all that sort of stuff. So our input into a building is always, quite often, is actually the arrival and the experience when you arrive. So we try, ideally, to work with the landlords as early as possible in the development of a building, or at least ideally where they're open to some sort of change, potentially if it needs it, to the main reception when you walk in. So, for example, our one in Great Cumberland Place, we were very heavily involved at an early point. It was still being developed, very much so. It was still 12 months, 18 months short of being developed. And we got involved very early then in order to be able to track the tenant journey, how they would use reception, how they would use the rest of the amenity in the building, including the end of trip facility, the cool front of house sort of food and beverage facility. That entire journey needs tracking. And quite often from an operator perspective, you're in a better place to be able to work with landlords because you see how people use the buildings on a day-to-day basis. You get that feedback on a day-to-day basis. You get to hear all the grumbles, mostly the grumbles, about things that don't work. And, you can fix those over time, and you can certainly fix them in new buildings. In existing buildings, you're always just trying to work with landlords within what you've got. And sometimes they'll say, I don't want you getting involved in front of house. I don't want you to just focus on workspace. And that's fine. That's a proposition we know really well. We can do that all day long. But what we decided was that the design piece was really, really critical, because we just felt that there needed to be real input into how things looked, and we needed to be taken quite seriously. So we built out our design team within x+why. So Phil, my business partner, is in charge of the design element, and we've got a couple of designers in-house that come and do that. So they will work with landlords on the building envelope. They'll also work well with tenants or members on the bespoke nature of their works if they require it, or adaptations to the workspace, or frankly, any adaptations to anybody else's, any leased tenant in the building that might require it as well. So we can kind of be a one-stop shop for people, particularly if, as I spoke about earlier, that we're doing other things like amenity within that building, so food and beverage, restaurants, club spaces, all of those sorts of things. We essentially become the one-stop shop where there's no computer says no moment. And you've always got that level of service, charm, no such thing as no, all of that sort of stuff.
So you've got the Marble Arch location that talk about members clubs. You've got a proper members club, a rooftop experience there. You're delivering an entire experience for the building. Now you're moving in, doing the same thing with WRE, Sasha Lewin over in Clapham. How do you convince a landlord who's used to investing CapEx to also invest in OpEx?
Well, I think there's 2 points to it. One is the kind of the wider amenity that encourages the overall performance of the building. So you can sort of say you're likely to need some sort of amenity in this building, rather than going to a third-party operator to do that, a third-party operator to do the front of house, a third-party operator to do the events, and then to do the service office. We can do it all, and we've got a track record of being able to do it all. And when you're talking about food and beverage, a track record is quite important because it's different gravy, literally.
Pun intended.
And so I think, there's an element there where you're going, right, value add to the building, and what does that mean for, let's say, leases in the building and values they can go and get for the leases.
So on that, are you showing that because they have this amenity, call it flight to quality, because you're hotelifying the building, are they getting an uplift in market rents?
They should be, yeah. Now, look, I mean, some it's worked really well. So I remember when we went into 103 Cornwall Row in Birmingham, and we were the first people in there, and we pitched them the idea of running a kind of club up on the 18th floor, and they said, you guys are nuts. And it had a 3,000 square foot terrace, and they already had D&D in the top of the building, and we convinced them to double the size of this club, right? It's quite a big building. It's 280,000 square foot. To be able to convince them that was the amenity that people wanted to come into this building. Now, we got lucky. You could say we got lucky on timing because it was just coming out of COVID, but they hadn't really done much leasing at all. And we convinced them to put us into that, along with some flex and 3 floors of flex. But we convinced them to do that, and then thought, oh God, how are we actually going to deliver this? Because this is like full kitchen, full chef, sous chef, a chef de partie, full event space, everything. And so that was that, and I'll always be grateful for those for the landlord on that. They took a real punt on us, but it is incredible and it's amazing. And what it led to, and again, it might just be coincidence, but the lease up in that building went absolutely crazy. It went absolutely crazy after that, and they filled. I think there's 1 floor available, but they filled up about 80% of it in about a year.
Who was the landlord on that one?
So I was Tristan Capital with Sterling, with a development partner.
In your experience, is there a certain profile of landlord or investor that really buys into this operational real estate strategy versus others?
So there are different profiles. I think the generational capital profile, the landed estates, are always open to a discussion around management agreements because they think generationally. They don't just think about selling, development, sell, go bigger. They kind of think, right, well, how do we maintain cash flow for family generations to come? And I think if you've got a long-term outlook like that, management agreements are quite appealing, and you can have, let's call it potentially a more creative conversation that's less around yield. And then I think you've got those that need, potentially in sort of bigger buildings, that need high quality amenity in it, particularly if they're in really nice buildings, right? They need good quality amenity. There's no point mucking around. And I think those conversations are therefore go, right? They need to have it. And so they might as well try and have a conversation with you if you can add value elsewhere as well. Because otherwise, typically we might be up against Savills on the front of house reception. We might be up against Vacherat and F&B, or we might be up against Compass or some massive support services business. But ultimately, if you can marry these two along with events and along with the workspace, then you've got that single platform that kind of works.
vertically integrated and more economies of scale that way as well with the staffing and so forth.
Yeah.
Makes sense. And I think we've sort of been diving deep in terms of the financial and the structuring and landlord sentiment. But when it comes to customers, the end user and the people signing up for the memberships and the license agreements, you're talking about members clubs, F&B experiences.
Yes.
You still have co-working, you still have offices. How do you think about the spatial allocation when you look at a building and you say, okay, we're gonna design this product stack in this building because of X, Y, and Z? What is X, Y, and Z that drives that for you?
Well, so we'll look at the local market typically, and we'll look at the design of the building. So look at the envelope of the building. Is it an X department store with a very deep floor plate with a lot of light issues? That will define potentially what we do. Is there enough, let's say, affluence in the local area to be doing, say, memberships? Is the heritage of the building interesting enough for people to want to come? Will the fit out be of good enough quality for people to come? There's a fundamental difference between, obviously, as we know, I'm teaching you to suck eggs, but there's a fundamental difference between B2B and B2C when you're selling. B2C is a lot harder. It comes out of your pocket, right? So the proposition is very different. Why should I join? Who's it for? Who am I going to be around? What do I get? Very different from B2B, which is office space. And I include co-working, I include dedicated desks in that, and I include private offices in that. Very different. That is quite often, as we know, location specific, and make sure that the fit out is quite nice. So typically what we'll look at on a building is we'll block plan concepts based on a target market, based on the building. We'll work out whether that works financially. We'll run endless business plans. We'll design and finance basically work very closely together. And then we'll get to a point where we think that we've got something that's viable that we'll put forward to a landlord and say, this is what I think is the right mix. Sometimes it's quite interesting just to not be all in on one particular thing. So potentially what that means is either holding back on some part of the fit out potentially to see what's popular. The other is to try different things. So for example, in Arding and Hobbs in Clapham, we have private offices, dedicated desks, co-working members for the members club. And the desks, which were put in because it was a really deep floor plate, super pop, all gone. And we just thought, wow, we've got 89 of these things. I mean, that's a lot. They just went with it in 4 months. Again, local area, they're going in and out of town. It's that hybrid working mentality. It's B2B. So it's not such a difficult sell. And they want something that's outside of their house, which they share with their 3 kids and their 2 dogs and a cat. And so those have been really popular, along with the private offices. And weirdly, the event space is also completely flown for reasons that we didn't think. We thought it was going to be primarily celebratory, your parties and things. But no, we've had, loads and loads of blue chip people down there because it's interesting, it's quirky, it's cool space, it's outside of town, it's a bit more experience led. So, you can start to sort of see, and then you start getting a really good idea of your pound per square foot return, whilst obviously, not trying to detract from member experience at all. You've got to always enhance, can't just do things for bottom line and bottom line only, but you can start to get a really good picture of how it then works and how you can adapt the building to be able to, major on those things.
It's a full circle moment for me because when Sasha was on the podcast several seasons ago, we were at MIPM and he was talking about this asset in Clapham Junction and the Arding and Hobbs building, and I think one of the questions I might have asked him, if I can remember correctly, is, don't quote me on this if you go back and listen to it, is why Clapham Junction? And Sasha was like, look, we believe that, you can get good value for money out there. We think companies will go there. There's a business community there we think we can tap into. And sure enough, what you're telling me, he was right.
I think all of those things are really smart. Like, I think it's a bit of an education when you go out of town into an area like that. And when I say out of town, it is ridiculously well connected.
Yeah. I mean, It's not out of town. It's still part of London.
It's 3 minutes into Waterloo. We've got a space in Victoria on Grosvenor Gardens. It takes me 14 minutes door to door. It's straight into Victoria, 14 minutes door to door. So it is ridiculously well connected. You're right. It is about, there is a local community, but there is also an education that goes into telling people that, they can come out of Waterloo or they can come out of South Bank and go that bit further without it being an issue, and it is still, when you take into account the rent, the service charge, the business rates is significantly cheaper, but the experience is better. Like, it's heightened, like it's more interesting. Now I get it. It's not for everyone because it's Southwest London. And therefore, whilst we all think that it's amazing. And I travel in from Basingstoke, where I live, so it's phenomenal, dangerously close. Not everyone does come in around Southwest London. And obviously that's why King's Cross and Paddington are their own separate nodes. But for those around Waterloo, for those around Vauxhall and other, main kind of core areas for business, for me, it's just a no-brainer. It might take a bit longer for people to get the idea, but the building is stunning. The experience is amazing. Connectivity is phenomenal. I had to say, I went into that building. The first time I went into that building was when Debenhams had just left. So it used to be, so the plotted, very, very brief plotted history is it used to be Harding and Hobbs department store, which was, set up in sort of late 19th century, absolutely loved by all the locals, burnt down, rebuilt, made famous by Mr. Bean. There's a famous skit of when he comes along and tends to be in the queue and takes a sofa on the top of his Mini. And it was super well loved and was an institution. And then Debenhams came along and was less loved and was less of an institution. And I went to go and see it when Debenhams had just left. The pigeon everywhere, pigeon poop everywhere. And I remember speaking to Sasha and just going, I thought you guys are mad. But he had this incredible vision for it. And where we aligned was, I think, in terms of bringing it back operationally to that kind of institution, not an alien spaceship in the middle of Clapham Junction, where people loved it for what it was and its heritage and its history, where they kept the elevators in, and where people would always be coming up and down the elevator. You arrived, there was a sense of life, vibrancy, and all those sort of good things. And we shared that kind of vision. We didn't just look at this and go, let's carve this up into 1,000 boxes and go for bottom line and bottom line only. This building has got serious, rich history and heritage and architectural. It's beautiful, and it would be a travesty not to have embraced that. And I think that's totally what they agreed with. That's them in a nutshell, and we love it.
Everything you said, I agree with. It is a gorgeous building. Congratulations. It is a great piece to your portfolio. One would say flagship, maybe.
Yeah. As I said, it's dangerous because we've got, it's full members club there. So, the wine list is good. The food is very good. And I can sometimes go in for half an hour and stay a bit longer.
Well, I'll be open to an invite if I can impose. No, it sounds amazing. I guess that sort of leads me to another question. Going into a community like Clapham Junction that's not city center, it's not Victoria, has your customer acquisition strategy changed to fill that space compared to everywhere else, or are you deploying the same strategies and tactics?
It's a really good question. I think that, as I said before, when you're dealing with B2C, it's a very different process. It's a different process of marketing. It's a different process of selling. You're talking about sheer numbers as well. So, you're dealing with individuals, multiple individuals. And so your workflows are very different. How you set up your HubSpots or your CRM, very different. How you automate response, where you market, very different. There's also, in a market like that, there are far fewer brokers. So you are less reliant on that. You're far more about things like word of mouth, brand, really important, experience, really important. All of those things help you to sell, particularly on the memberships. And then with the office stuff, you do have to think a little bit differently again, because you're less reliant on brokers. So you might hit bus routes, you might hit billboards, you might hit local signage, you might hit all of those, and you might try lots of different things. But I tell you what, quite often it's word of mouth. So a lot of people, and that's the beauty of it in a way, because you build community that way, is a lot of people go, I know so-and-so and I bought so-and-so, and yes, because I know that person and they came because of me, because I met that person. That is super cool, because you basically end up with this like super hyper connected community of people that almost to a kind of 2 degrees of separation know each other. That's pretty magical. Like, you're not leaving. You're not leaving then.
So the word of mouth is a tactic that you're able to deploy there pretty well.
I think in other like more conventional sort of straight up grade A offices, it's a race to get people in. It's a race to get revenue in. There, that's totally right. So you'll use some of the same approaches, particularly on marketing and sales there. You'll use a lot of brokers, and your brand, you hope your brand does a lot because people want to be part of that community. But the fact is you don't have a lot of time. So you've got to get people in, and therefore you don't have the same, because there is just so much more at the top of the funnel that's coming in those sort of central locations. You don't have as much ability to kind of curate in the same way, certainly not at the beginning, and you have to it just takes a bit of time to be able to curate those sorts of things. So, that's the downside in some senses. It kind of feels less risky though.
That's a great mic drop at the end. While you're talking, especially when you were talking about the architectural features of Arding and Hobbs, you reminded me of I was out in Clapham Junction on a Saturday a while ago now, and I passed the building, and so I snapped a selfie here of the building, yeah, and I sent it to Sasha because I was like, oh, I gotta tell him I was near his building, and he was very pleased to see that it was getting some traction in the LinkedIn.
Yeah,
sphere.
it's got a lot of traction. I think there's a lot of love for it. I just think there's a lot of love for it. It's beautifully curated in its totality. Like, it's not just us and our influence. You know, they did an amazing job. They got Third Space in there. That's phenomenal. They got Botanica Hall, which is like a really popular place to go and eat. They got Prezzemole, which is, you know, a really upmarket kind of Italian place. And so I think to the point I mentioned earlier, they curated that. They didn't just say, right, whoever wants to come and take some space, take some space. I'm sure there were other gyms that were looking. There were definitely some other F&B units that wanted to go really unit down the bottom. And the same for that Prezzemole near the entrance of Arding and Hobbs. So I think the whole thing comes together. And that's why I think people love it. People in the local area love it. And then it also means that it's actually a little bit of a dream to be able to design within it.
I think it's a prime example of something that we talk about a lot, about the adaptability of space, and to be able to redefine the purpose of a heritage building. I think it's just wonderful to see. That's where the community spirit comes from, I guess.
I totally agree with that. And I think what's really interesting about that, what you guys do here at Mute, is that there is, in those big box department stores, acoustics are difficult, right? And I think flexibility, as you say, is really difficult. And I think, you know, you're constantly trying to work out how you can improve those things. You need adaptability in terms of partitioning and what you put on as a product. And you need to make sure that you're not in an echo chamber. And so there are so many different challenges, but what they give is charm. You know, they give life, and they give something a little bit different. If you can overcome those challenges, create, as you say, those kind of community values, and there's a real sense of localness there.
Yeah, I think it's retaining the essence of beautiful buildings, the heritage of the building, as you say, that how it supports a community. We do a lot of work with a Professor Robert Schmidt, who talks about adaptable futures, and he talks about more than half of the buildings that get demolished is because they're not deemed to be fit for repurposing. We would question whether that's true or not.
I totally agree, and I think we've all got an obligation to do that, right? To work with what we've got. I mean, there's some crazy stats about the number of buildings that will exist in 100 years. About 95% of them should exist today, and I think we shouldn't be necessarily where we don't have to knocking down these things and creating net zero carbon in operation buildings when, you know, the net offset has been felt in the raising of the original building. But I completely agree that also we've got a responsibility for the heritage of these buildings. The stories these buildings can tell you is amazing. And when we went into the Arding and Hobbs, we went and we found a safe right in there, and we went and opened it up, and it was just full of what we were hoping was going to be gold bullion, but sadly wasn't. And it was just full of old receipts and really interesting, the original deeds to the building and all of that sort of stuff. And it's funny, everyone's got a story in quite often the local area. So we were putting on a yoga session the other day, and the yoga instructor said, I just want to show you a photo. This is my grandfather. He used to be the general manager at Arding and Hobbs in his white tie and all that sort of stuff. And man, that's just dreamy. Right? And why would you ever get rid or not harness that in any way?
You mentioned when you walked in here, it had a lovely feel. I mean, we feel that this building carries a certain energy, but something like that, to have that level of history available, and some people feel it, some people don't. You know, the ability to walk around the space like that and just feel the beauty through time.
Yeah, well, we always talk about the first and last 5%. So that experience when you come into a building, that sense that it gets, which quite often is in the design, but often is in the people as well. And particularly if you've got a heritage building, stunning.
I think it just adds to the story, and the story creates the brand, and the brand attracts people that are aligned with that, the values, the history, and the people behind it throughout the history. I know we've really gone down deep on Arding and Hobbs, and I appreciate you sharing all of this. Has been fantastic. And now I know how Sasha is affording the capex. He buys these buildings that's got gold treasure chests in them, and now it makes sense. No, in all seriousness though, I think it's important to go deep on that. But it also brings up another question for me. As you're growing from location to location, you rightly say when you curate the workplace design, the amenities that you're going to put into the experience, you look at the building, you look at the local market there, you look at the customer makeup. And then you get in a building like Artigan's Hobbs, it becomes your flagship. But from a brand perspective, how does that impact your brand going from location to location, that the experience is different and it's not the same?
Yeah, I can. That's a really, really good question that we, for a long time, battled with, because when we started up X and Y and all those values and the mission that we were trying to do, and our mission ultimately is to change the way the world works for good, it's really like it's a home run when you're in East London, where you've got creatives and entrepreneurs and charities and social enterprises all combining in one creative space, right? Where you can do all of those things, you can inspire them every day, and you can amplify their amazing story. Now, how do you apply that in West London with private equity and hedge funds? And so that's been the kind of journey for us. And the answer really is in the sense of convening. So for us, we can use that space to build the narrative, to convene people around this idea of better business or wider impact within for-profit business. We can do that, but also you can start to choose your own adventure. So for us, one of the core pillars that we talk about within experience is impact. So if you're into impact and you want to know about how you can also create a more sustainable long-term business as a result of thinking about people and planet, then we will inspire you, and we will put on amazing shows and things like that, and talks and all that, and intros and partnerships to be able to put you on that journey. And that's our love. That's what our fundamental brand and the reason why we're set up. But alongside that, you can't ignore things like fun, right? So food and beverage, you can't ignore well-being, and you can't ignore entrepreneurship and promotion of business generally. And these are other pillars that we put on that are also can promote culture in West London as much as it can in East London. So you're kind of like creating your own adventure, essentially pick and choose what you want as a member, but we're doing it at different spaces. So for example, if you want to go clubbing till 1 a.m., go to Warding and Hobbs on the roof terrace in the summer. If you want to go and listen to Clover Hogan do an amazing talk about climate change, go to East London and People's Mission Hall. If you want to come and listen to Richard Branson talk about how to promote entrepreneurship, come to Great Cumberland Place, and so on and so forth. And then through the app, people can aspire and see all things. They can work out what they want to do, but part of that will be that impact will be one of the core pillars of that.
I want to come work at X and Y now. I mean, this is amazing. I love that. And what I love the most is that you didn't say anything about aesthetics. I asked the question around workplace design and continuity of the brand. How do you do that without it being the same everywhere? Because you think about brand as being the same thing, same experience everywhere. Starbucks, WeWork, Marriott, whatever. You didn't talk about how it looked. You talked about how it felt and what the programming you did and the values and the impact that you guys are helping curate.
For sure. I think, first of all, every building is the same brand, right? So it's the same thing. You'll very rarely see X and Y in a building, just because that is probably for a different reason. That's mostly because we felt that people wanted to be in their own building. You know, they wanted to put their own building on their address, right, rather than an X and Y. And because every building also is fundamentally different. It's different in all the ways that we suggested. It's different in its heritage, in its history, in its building, in its target market, in its layout, in all of those sorts of things. So you kind of have to embrace what that building is. And that's kind of the fun. It's like, what does that building bring in terms of that wider community piece and that wider experience piece? What does it do? Has it got event space? In which case it's really cool because you can put on a variety of convening based events. Has it got food and beverage? Has it got a club? That's super cool. Has it got a terrace? That's really interesting. Is it just workspace? In which case, how will those people like to access the different parts of, the other buildings that can put things on? So I think there's always those ones, but it's never about X and Y. It's never about the brand in that sense, other than the things that we put on. It's always unique.
Well, I really like that, because I think putting values out there front and center is what develops the brand. It's what attracts people who are aligned, and they feel like they belong when they come to an X and Y building because of that. So kudos to you for that. As you've built up your portfolio, 16 sites now, assuming you're growing to is there a number you're growing to?
No.
Okay.
It's an unlimited game.
Okay. Unlimited. So 1 million. Yeah. We'll see 1 million sites at some point. But as you've grown this portfolio, you now have, the need to drive customers into presumably every site, just like every other co-working serviced office company has a number of meeting rooms. You mentioned dedicated desk earlier. I assume you have hot desk and day passes. And with 16 sites, I would imagine you have hundreds of meeting rooms now. And in theory, you could have maybe hundreds of day passes booked in a month. But the biggest challenge that we have in the operator game is those footprints of inventory sit under monetized, the occupancy versus vacancy. We could have 100% occupied workstation count, but the meeting rooms, even if they're being utilized, are under monetized. I noticed on your website, you've got e-commerce set up so people book online. Are you seeing, I'm curious to see understand the makeup of revenue from meeting rooms and day passes. Is it strong? Is it under? Is it growing?
It's quite location specific. We use the Office R&D, if I'm allowed to say, sort of e-commerce growth hub, as they call it, to be able to book day passes and meeting rooms, etc. Some sites do better than others. Quite often you get a loyal following of, a few people that know a few people, word of mouth spreads again. Generally, though, it does pretty well. It's like in terms of that e-commerce platform, it's busy. And I think we just opened it up in a single room at Arding and Hobbs in one of the largest rooms. I think it was like 3 weeks ago, and it makes I don't know, about 1,800 quid a week. So it's not bad, and otherwise that room might have been void. It might have been sat empty. That's not a meeting room, by the way. But we also do make sure that people can access the meeting rooms externally. There are preferential rates for members, obviously, and they can book earlier. But that's it, really. So you've just got to, I think there are a number of things. One is to be clever about things like credits, which this market and sector has been particularly bad at, thanks to our friends at WeWork originally, who just gave away endless numbers of credits. And that set the benchmark. Well, I can get, £500 worth of credit every minute over at WeWork. That gets quite hard to compete with sometimes. So you have to work out how you're allocating a certain amount of freedom to your offices. And maybe that's just by designing a couple that are smaller, that you say, that's that, and you don't monetize those, which we've done quite successfully in a couple of buildings. And then I think for us, it was about, then you've just got to get the right makeup of you don't want people coming up and saying, I could never get a meeting room, but you also don't want them to be completely empty the whole time. So you do think you've just got to get that right. And then also you want to make sure you get the meeting rooms that are used on an hourly basis, and you don't want too many of those. What you really want is you want 2 or 3 that are used on a half day or day basis. So people will go in there for the whole day and they'll appreciate it a lot more. And they'll obviously also probably get like food and beverage in there and other things in there. But that's when, you could take a whole day out rather than the transient nature of the hour or the half hour or the 10 minutes.
Yeah, it's higher margin. You've got less staff costs from turning the room over, and
correct.
Especially if you're getting the ancillary services coming in on top of that. If you're a flex operator still juggling spreadsheets and manual rate sheets, stop. You don't need to be a wizard to outsmart the big guys. You just need FlexSpace AI. It's your AI-powered revenue team that never sleeps, optimizing prices, automating marketing, and filling your space while you focus on your members. No burnout, no guesswork, no what-if tabs at 2 a.m. With FlexSpace AI, your building works as smart as you do. Now head over to flexspace.ai/brave and start growing your revenue today. In our Flex business, we preach agility to our customers. Often we see that we have a large suite that's not selling, we convert it to meeting rooms, or vice versa. How are you thinking about the agility for your own business to understand, okay, you're going to do the best you can working with design and finance together when you're pitching, but then when you then deliver and something's not performing, how do you enable your agility to be able to change the makeup of the floor?
So I think there's a difference between speculative and non-speculative changes, essentially. So quite often where someone has come in and asked for something, you've got an easy business case. It's a cost of sale, essentially. If they don't want to pay for it themselves, you can go to the landlord and say, listen, we need this because this is the business case. It's a no-brainer. It's a home run. When it comes to things like meeting rooms, it's a lot harder, right? And you are constantly looking at the data and saying, what do we need to do to be able to adapt this space, to be able to make it work harder? But the reality is it's harder to prove a business model because you don't know it yet. You don't know. You've got data, but you don't know exactly how, if you did change it, that people will go and use it. And you can ask for their feedback and all that sort of stuff. But sometimes they don't do as they say they're going to do. So that's a lot harder, which is why, pods are really interesting in terms of meeting rooms and all the stuff that Mute are doing. I think is really sort of clever about how you can do that and adapt space really well.
Across, I think the speed of change is one of the most important factors, because if you are trying to respond to a need, you need to be able to respond very quickly, because as you say, what you're being told might happen, may not happen if it takes 6 or 8 weeks to make a change up.
Speed is key, right? And flexibility and agility, as we've just said, is key. You need to be able to do it relatively quickly. But expensive.
Well, on that note, and this is, underlying the big challenge is the cost, right? And speed and cost is money. We're sitting in a podcast studio today. It's a meeting room tomorrow. It could be an office the next day. But it also is built for a certain size, but it can be changed to adapt to the size needed. Gary, how have you seen companies address this need for adaptability and speed to market?
So before I answer that question, picking up on your earlier point, Rupert, about risk aversion. So what we're finding is that we can de-risk a lot by suggesting a modular approach to the built environment. It then naturally gives us a quicker response. Then if you have a series of rooms that aren't being used, but you know that the people are in the building and you are gathering data, then we often find that there are too many 8-person rooms, not enough 2-person rooms. With a modular approach, it allows you to low cost experimentation. It allows you to maybe change up a series of spaces for even 3 months or 6 months.
For sure. And it's better for the planet.
Yeah, absolutely. And then do that thing that we always used to refer to as reverse decision making. You've made a decision. It was the right decision at the time, and now it's not. So you have to respond very quickly. But as you say, to the planet, and interesting that you're a B Corp, because it's something that we're looking at the moment. And that comes back into community and lots of other things, but that's almost a separate conversation about that. But I think we can respond quickly. We can allow change to be made at minimal cost in the quickest way possible, de-risking, allowing you to try things.
Well, I think what you described with the reverse decision making is effectively synonymous with agility, and this is exactly the key point that I was making. And I think the 1-2 punch to this, though, is designing for modular use and being able to be adaptable in the physical realm is one thing. Then in the digital realm, going back to dynamic pricing, we talked about this earlier. E-commerce. I'd be curious to hear how you're addressing that when you've got this whole inventory, thousands of customers, you've got traffic coming on, booking meeting rooms, and there's also the negative actions of people going in and not inquiring, but like going through a process and not booking. Are you guys changing prices for different days, adjusting with demand, offering different deals? How does it work for you, for X and Y?
Yeah, so I think we do dynamic. So when we talk about dynamic pricing, just to be clear on what I'm talking about adapting pricing for weaker or better periods of demand, right? So yes, but we do it in a fairly basic way at the moment. So, you know that your Mondays and Fridays are going to be quite quiet. So we'll reduce the price then. Your Tuesdays, Wednesdays, Thursdays are going to be expensive. So you'll increase the price then, but you'll also bring potentially another couple of rooms into players' meeting rooms, i.e. offices that might suddenly become meeting rooms if you're feeling, if you're really full. So I think you can flex. Then you've got dynamic pricing as it relates to office space. So obviously, as we all know, most of us are always trying to adapt to a target based on demand. And there is constant pricing shift that happens on, and don't let any service officer, don't let any operator tell you otherwise. But every single time you're looking at, can I get more flexibility in my pricing based on what I've sold the previous office for? And I think that level of dynamic pricing is really interesting. And it gives the sales team a lot more flexibility rather than just saying, that's the price, that's the list price, that's what you've got to go and do, because it's got to reflect the amazing job that they did on a particular office space that maybe it was really large, which means that there is a bit more flexibility in what you do now. So back to your arbitrage around time v income, if you can get something that's a little bit less than price, but you get it today, you should do that deal. And you've only been able to do that deal because of the dynamic pricing nature relating to the deal that you just did the day before. So I think there's a lot, but that is mostly run through a spreadsheet, still run through Excel.
Wow. You must have like a revenue manager on site that just does nothing. It's just what I like to call the freaking sheets, the spreadsheets.
Yeah.
And so what's your view then on putting AI behind that and automating it?
Let's do it. I mean, I think, so we've just hired a new COO because I can see, amongst other kind of weaknesses in my own management style, I'm sure, but part of what I think that we've all got to embrace is this idea around AI and the future of data data lakes, workflows, all of these things that are so different from an entrepreneur setting up a business and driving some revenue, right? This is about the long-term sustainability and profitability of a business and its relevance, frankly, in the next 2 to 5 years. And if you're not on it, you're probably going to be quite old school. You're going to quickly look like what, a typewriter would look like today, or a homing pigeon if we're not careful. So, and I think there are fundamental efficiencies that can be made to business, but also much better experience that you can provide to your members as a result of taking on some of this data and using AI to disseminate some of this data, right? So it's not just about cost saving. It's actually about personalizing experience based on how people have used the space, what they've come to, how they've used it, who they've engaged with, all of those sorts of things that are probably as data points all over the place. But actually, if you can start to disseminate that into, right, defining a target market, working out what sort of event people want to come into and all those sorts of things, you're a very, very powerful tool. Now, we're nowhere near that yet, but we've got to start thinking about it. And so that's the kind of priority, I think, that we are looking at as a business for the next kind of 2 to 3 years.
New business ideas coming up on the Brave Ideas podcast. That's fantastic. I think what you just said is technology enabling us to deliver better hospitality, giving people the exact product they want at the right price at the right time. 100%. This has been an amazing chat. I think this is the longest I've spent in the same room with you.
Yeah.
I want more of it. This is so good. Congratulations for all your success, and wishing you much success going forward. My final question to close this out, Rupert, is looking ahead the next 5 years, what's in store for X and Y?
That's a great question. I wish I knew the answer to it, but we'll just continue to grow. There's a lot of pressure on people, to think about when they start up a business, to think about exit and how you make money. But I also think there's not enough on building long-term legacy businesses that you can hand down to your children. And I think if your priority is around building a long-term sustainable legacy business that you could hand down to your children because your governance was spot on, your risk profile was great, and you built a decent business on values that people wanted to work for, then I think you've got, who knows what's going to happen. So we'll just focus on the kind of things that we can control and the things that we want to get good at and be better at. And we'll just see what happens. But more spaces, more experience, and see if we can innovate a little bit along the way.
So what I heard was 1 million locations. Yes. Okay. Well, no, well said. Well said. I think any entrepreneur wants to create something sustainable these days. And that is the core to B Corp anyways. And then if an exit opportunity comes up, well, you always entertain it, right?
Yeah. Who knows? Who knows?
Well, all the best to you. Gary, thanks so much for the co-hosting.
Thank you, Caleb. Pleasure as always. And Rupert, thank you so much. It's been a real treat to interact with you today.
Well, but also thanks for having us, and thanks, Caleb. Thanks for having me on.
It's my pleasure. Thank you for tuning in. Until next time, take care of yourself. If you've enjoyed this episode, be sure to subscribe at braveideas.media. And I'm actively sourcing buildings for brand-led hospitality repositioning. If you have a lead, an owner considering a sale, or a partner brief, DM me or reach us at bravecorp.co. And until next time, take care of yourself.